Hey, we're live. Welcome, everybody. Hi, Richard. Good to see you over there. Let's see. We're all getting set up here on this slightly warmer Thursday than it was last week, but still a bit cool. Still got the long sleeves on. It's August. Don't get me started. All right. So we had a little bit of market action over the last week. Nothing too crazy, but some good moves. So can everybody hear me? Please just let me know in the chat. If you can hear me, I'll just say hi to everyone. I assume you can, otherwise people would be saying, what? Can hear you.
Yeah. I was going to say, they'll soon tell you if they can't hear you.
Yeah. All right, Luke from Marbella can hear you. All right, good. Andre. Global climate crisis. Exactly.
Yeah, you two guys will get on well.
Yeah.
Global climate crisis is not.
That's right. Mika, Sandra, Dom, Johan. We got lots of Giandrea. Got lots of the regulars, lots of new people on. Good to see everyone. Okay, so today's going to be a little bit different. We're going to have a little bit more of a fireside chat. We wanted to mix things. We always want to mix things up, and we want to cover a lot of different topics, especially things that maybe aren't so widely discussed, or you kind of have to have an inside track to know about it. So we want to have some education. We want to have some some practical applications. We want to have a little bit of everything. So that's what we're going to explore today a little bit. And actually, I got the slide up here. What are we talking about today? We're going to talk about random market events, and random in quotes because they're not always very random. And we're going to get into that. But we will look at the market analysis. I will share my screen. I'm also going to share a new tool. I don't know, maybe Richard wants to talk about it as well, but Deribit has a new tool. Which we'll show you, called the Options Wizard. And I'll show you how to set that up and how to use it. And then, of course, we will chat about these random market events and then open it up to Q&A afterwards. So let me, let me just turn the slides off right now. Now, I do have a poll today, a poll related to our message here. Oh, I'm having trouble clicking the right button here. There's our poll. Here it is. Do you think that the crypto, and this is just crypto markets, do you think that the crypto markets are stochastic? Are they basically random? Do you think that they are random?
It's unanimous.
Yeah. So the first option is completely random. Yes, it's just you're just grass in the wind. Number 2 is mostly random, and then number 3 is not random at all, which would be highly manipulated. So let me know your thoughts, and of course we'll come back to this poll near the end of the call and see where we're at. But yeah, it'll be interesting to see. Okay, all right, and we've got some questions coming in already. Great, we'll get to those. If you have questions during our chat, just post them in the Q&A section in the chat, and we will get to them at the end. So let me start things off. Why don't I jump over?
Some epic questions, actually. So
yeah, excellent.
Leave time for these.
Excellent. I'm going to share my screen, and I'll go over to Ethereum, and you can see my screen here? Everyone can see me?
I can see it, yeah.
Excellent. So if I scroll down to the bottom, I got this option wizard. Now, how you get there is just up here on the top hand right, you can see this add component. Just click on that, and then there's the component. You scroll down, you'll see option wizard right there, right? Yeah. And then you just want to choose Bitcoin, Ethereum, whatever you want to see, and you'll come up with something like this. Number 1, you choose your currency. 2, your expected price, where you think the price will be in US dollars, the period of time. So we can just, let's say we think it's going to be at $2,000 at the end of October. So basically 2 months away. And our total investment, we can have, 0.1 ETH. Let's say you've got 1 ETH in your account. Obviously, you're not going to bet the whole thing. At least I shouldn't say obviously. I assume you wouldn't.
And it's important to mention that this number is the amount you're willing to lose on this trade.
Yes. And
not the notional size of the options trade. Yeah.
Exactly. Max lot. So let's say I've got 100 Ethereum in my account. I'm a high roller and I got 100 Ethereum in there, and I'm willing to risk 1/100th of that account, 1 ETH. And then you just calculate the strategy. It's going to come up with some, it's not going to get sophisticated on us. It's going to keep it pretty basic. But here we can say, or here it's telling us to take a long call position. You can hover over it. It'll tell us what a long call is. It's telling us to buy the 1,800 calls, so slightly out of the money. And it's giving us the expected ROI, your P&L, and your maximum.
Just to be clear here, Shane, it's telling you to buy 34.
34 of them, yes.
1,800 calls with
34,
your one.
Yeah.
Because the price of each of those, because the price of each of those calls is 1/34th of 1 ETH, and your total investment is 1 ETH.
Yes.
This was not obvious to me to begin with. When I first looked at this.
So let me go back to, most people don't have 100 ETH in their account. Let's just say we want to do 0.1 ETH. Let's see what it comes up with here. I assume it's going to be the same strategy. And here we go. Three contracts of ETH if you want to bet 0.1 ETH, which is about $170 worth, $170 US worth right about now. P&L on ETH, P&L on USDs. And here's the maximum loss, which is basically what you're betting, or very close to what you're betting in your total investment. So you can do that kind of stuff. Now, let's say we thought the price, was going to be the exact same as it is right now, or pretty close. What's ETH is at? Well, $5 away. So it's $1,700. Let's say we thought it was going to be exactly in this place, October 27th. What's it going to tell us to do? Probably a covered call or something. Oh, no profitable strategy exists. I haven't seen that yet. That's quite interesting. If I had 1 ETH, would it give me something different? Probably not. Let's just see. Aha. It did tell me to do a covered call in this case. It wasn't worth it with 0.1 ETH. So in this case, if I wanted to bet 1 ETH, that the price would be where it is now at the end of October, it's saying, look, do a covered call. It's giving us an ROI. Not a heck of a lot. So you can play around with this strategy. Let's say we thought it was going to go down. Let's say we thought it was going to be around 1,500. October 27th. We're supposed to buy some puts. What else are we going to do? Yeah, long put, 22 of them with 1 ETH. So you can come in, you can play around with this tool. It's a new feature. Richard, do you have any thoughts on this tool and maybe its limitations?
Well, limitations, of course, but I think it's kind of cool because it starts making you think in the same way that a structurer starts to think. So when we're designing structured products with options, we're actually putting a bunch of options together in order to sort of draw a payoff curve, a custom payoff curve that's not just the standard, long and up or long and down that options are. It starts to get you into that mindset of actually, I could buy more options than I need for this strike and then sell more than I need for that strike and then buy a load for this strike and actually create a payoff curve the way you think, actually, if I think the price is going to land in this range. And if it does land in this sweet spot where I think it's going to be, I want to maximize my payoff. And in fact, that's how you may have seen products out there called things like shark fins that are just starting to make an appearance in the crypto space. And that's how these are constructed. You actually take 4 options and buy and sell them in various ratios in order to construct your payoff curve. That is zero risk with respect to the interest you can earn. So the idea is you put your money on deposit, use the expected interest to buy your option structure, and then maybe increase your returns.
And the payoff diagram looks like a shark fin.
Looks like, yeah.
Why didn't they call it a dolphin?
Well, or just a triangle.
Just drama, right? For more drama.
Exactly. Yeah.
Okay. So let me just share my some charts here. I'll go through kind of what I got going on right now. Then I'll hop over to Richard. I've got nothing in Bitcoin. That's coming soon. I'll have some stuff in Bitcoin. Taking a look here, I've got a few diagonals on. I've got the diagonals that I put back on, a few weeks ago in the middle of summer. I've got October, November. Those are the long calls. I'm selling the weeklies against them. Sometimes I'm rolling them if it gets close to my strike, just managing those every week. The idea is that by about mid-September, these long calls will be completely free. So if they do pay off, it's free money. Okay. I won't stop selling weeklies against them, so maybe it'll actually earn me something. So that's great. Same thing. I put on these diagonal puts. I bought 1,800 puts, selling weeklies against it. I did put on another set of diagonal puts after this drop we had back on, I think it was like the 17th or so when that dropped. Nothing too fancy here. Just got a few diagonals on. I've had the odd trade here and there, some spreads, some debit spreads, some credit spreads, put on some naked things every now and then. So, for instance, when this thing went up, I did sell some calls already out of them. Came down. I took opportunity to sell the weeklies. I still got these long puts. Nothing too exciting because there's not a lot going on right now. I'm earning, maybe $25 on the one account that I report on this account in theta decay, which is fairly average because it's got about 7 ETH in that account. I'd like to have it a little bit higher, but I don't want to push it right now. Vols are dropping. I think I took a look this morning, Rich, and I could see the D-vol in both Bitcoin and Ethereum where we're coming off fairly well. So not a lot.
I've got us about 33 vol at the money out to a month, and up to 38 to 45 between 3 months and 9 months at the moment.
Gotcha.
Yeah, it's come off a lot.
Actually, I think the one thing I didn't add in here is I think I did put on a risk reversal around here where I bought the put and sold the calls. I ended up rolling those calls up. I still have the puts. I forgot to add that in because I forgot about it. But that's about it for me over on my side.
Yeah. So yeah, I can just share my little playbook. I've got a $45,000 book that I play with the full blessing of my spouse. Let's have a look.
Good thing you threw that disclaimer in there.
Yeah, and you'll see. I'm actually pushing the boundaries of margin use here. Always testing the limits. So before we had about a 6 or 7% rise, didn't we, in Bitcoin? And I was using about 50% margin, I think, prior to that. And then we had that rise. We had that spike up. This book, I just hedge it occasionally when I feel like it. So I'd sold a bunch of calls and some risk reversals on this. So they're all getting pushed up. A few of them got in the money. Those around the 1st of September, I've cleaned away and rolled. I think I can't remember now. But yeah, I've got a couple of positions left on September. There we go. Where are we? 28k calls. That's fine. That's going to expire with us. And then today, I just started selling some 10 delta calls just to see if I can soak up some of the last residuals of the vol. And that's only because I see vols yesterday were slightly up. When this spike happened, we were like plus 5 in the wings towards the calls. So I thought, and we were 10 deltas of smile. So I figured I could pick up 12 deltas of value by selling the 10 or 20 delta calls and buying some slightly cheaper puts. My puts are out at 1 month. My risk reversals are out at 1 month. And I'm pushing it with these 28k calls probably in 1 month. But you know what? We're going to get some time decay. I'm going to get a chance to roll those away or do something with them. So I'm happy about that. There's nothing really here that's concerning me. And I think looking at the way of the vol action, looking at ETH is getting bearish. The vols are rolling around to negative skew. Actually, quite strongly given the move up we've had. You get the feeling that the market doesn't believe it. So my position, I'm happy to be slightly negative delta in terms of dollars, which will consume a load of margin because I'm essentially short loads in terms of Bitcoin. Yeah.
And just regarding that, so I just hopped over looking at the volatility surface on ETH, and I can see it's skewed to the put side right up until about the end of March of 2024.
Yeah. Basically, everyone's pessimistic, and except about the halving. Everyone's still optimistic about the halving.
Bitcoin is a different story, but yeah.
Well, it's similar. Bitcoin is slightly less pessimistic. I was reading in some of the notes I was getting through from some of the prime brokers that there's a big whale who's selling short-dated calls on ETH, massive overcovering of calls, and then whenever the market moves up, he rolls out to a month or 2 months. So he's like, he puts pressure on the. He actually does enough to put pressure on the surface.
Interesting.
So we could be seeing that.
And just a quick note. So we're used to seeing your little margin bar at the top there, yellow. It's red today. As you said, you are pushing the boundaries. Now we do, when we're talking to newer traders or just kind of the average retail, we do have a rule that we don't let our margin get over 30%. That way, in the event of a dramatic move, we've got some firepower left. We can roll. We can do whatever we need to do. We can take advantage of a spike in volatility. You name it. But Richard does a different style of trading in those particular accounts where he's hedging often. So he can manage that risk if there's a move.
Yeah, I'm actually getting married on the weekend and about to go on my honeymoon. So of course I'm going to remove a lot of risk from my book for that event, so that I don't have to make excuses to go slink off to my hotel room to trade.
But Richard, it seems to me like you're replacing one risk with another one.
It's a much bigger risk. It's guaranteed loss, right?
No, we love Olga. We love Olga. Okay. So that's what we got going on. Check out the trading tool with Deribit, this new thing. Again, it's going to give you basic stuff. We're not going to get complicated positions going on there, but I think it's a great starting point. And as Richard said, you can use this as a starting point, and then, as we've talked many times, our options positions and strategies often evolve into other things. So if you've got a direction you think it's going to go, we don't usually trade directionally. That being said, I've got diagonals on which are directional. That's only because we're busting out of summer. It's going to go one way or the other, likely. It might not. It could stay flat for 3 months. Who knows? Anything could happen. But either way, I'm happy with that trade. Hey, Richard, do you want to jump on to some questions now, or?
Let's do that.
Sure,
So
sure.
Okay, so Andre, during the last market shakeup, I've managed to roll up short legs of my short call spreads. Good, but I'm still not sure what to do with the profitable long legs. I'd like to close them, but this would bust my margin, and I don't find good opportunities to roll them further and up to credit. Right. Well, if that's the case, you're overtrading, because you have not left yourself firepower to roll and duck with the punches. Because normally my advice would be, yeah, sure, if they're in profit, buy them back and then wait for a chance to resell them. If you feel that the market's going to revert. In your case, what you might want to do is buy back those puts and then just buy a couple of futures. And with the intention, and what that will do, it'll slightly lower your delta, and it'll make the margin engine convince the margin engine that you're less at risk on the upside. And then what I would do is just monitor your margin every day, because monitor your delta every day. What you find is that if you're all short calls and long a couple of futures, your delta will decrease every day. It's called delta decay. And as a result, you will get shorter and shorter as time goes past. And so you'll be able to sell a little bit of that future day after day after day. And then if you see the market break down to the downside, you can always remove that future and trade it, and then go and write the puts again and get rid of the future. So that's what I do. I just use the futures to soften the blow. Sounds like you're overtrading on the call side. And to be honest, you'll probably be okay. I don't really see any massive upside, unless there's some bolt out of the blue news. But still, if you're that tight.
And Andre, I wouldn't mind knowing what your margin use is at. I mean, you don't have to tell us, but are you in the danger zone? Are you up? Is your bar yellow or red? Let's not be quite like Richard. Actually, Richard, maybe what we should do before we answer any more questions, let's just cover. I thought
another thing you can do, of course, is buy back some of the calls and resell them as puts and flatten the deltas that way. If you think the market's going to stay where it is. Because when you roll the calls, you could always roll them into strangles rather than rolling them into calls, and that way you'll have enough, and your deltas will be flat, so you can buy back those puts.
Richard, before we go on, actually, I thought we'd have a bit more time. Let's just cover those there's a handful of talking points we want to talk about with these random market events. then we'll jump back into the questions. And what the theme was, we were getting some moves without news plays. And there's questions coming up and saying, well, what happened? What happened? Well, something doesn't necessarily, the other day we had, the SEC ruling came out, moved the markets a little bit, not a lot. But sometimes things happen for no reason. And, I think especially you, Richard, have a bit more insight because you're talking to a lot of market makers sort of day to day. You kind of understand that game on the back end. There's a macro viewpoint going on.
So we had this drop down from 28K to 25-ish, didn't we? Well, it was 25 at the bottom and then came back up again a bit. So a lot of that was kind of liquidation covering and so on. Kind of implies to me, what it felt like to me was that everyone was over leveraged, desperate to get yield. Now, the crypto markets, the options markets in crypto have not been big enough historically to move the spot markets. But actually, these days, I think that the volumes or the notionals traded are about equal between the options markets and spot, which means that the options markets are now significant in terms of being a driver of prices. So if you can imagine a scenario where everyone's used to, pulling out, 50%, 100% a year from selling vol, and that's all been super easy for the past, year, and then suddenly all the vols start dropping, and they're not making as much money as they were, and perhaps the hedging costs are starting to impinge on the profits to the point where they're not making any money at all, maybe even losing it. Then this feeds into one of the questions by Stanislav, actually, which is what's the difference between institution and retail traders? Well, a retail trader might have fixated on the returns that he thinks he's owed by the market. I use that term advisedly. So once you start getting good at this and you start making money, the first trap you can fall into is thinking that the market owes you a living. And the trap I fell into 25 years ago was I immediately quit my shitty job to make money from the markets. And I successfully made money from the markets in huge amounts for 18 months after doing that, and got to a stage where I just assumed I'd be fed and clothed by the markets for the rest of my life. But of course, it isn't like that. It's all very well for us retail guys to do well and make profits. But what that means is that someone on the other side of that trade is losing money, and that other guy is a market maker. Now, we're saying that if we're short vol and he's long vol, he's still able to make money by trading the futures markets against his gamma, so he can maybe sit and weather being long vol and let you make money, and then in effect what he's doing, he's making money from the spot market or the futures market to pay you, who's making money from the options market, which means that someone's losing on the spot market. And in the end, someone has to run out of money. And so what you'll find in the good times is that loads of little market makers set up and say, I can do this. And they start market making. This is easy money. They go and borrow $5 million, put in $500,000 of their own collateral and start market making, and they make a living at it. And then the market gets wise to the current paradigm, and everyone in retail figures out how to make a living. And of course, these market makers start getting bled dry. So the smaller market makers start to disappear because, of course, they can no longer make a living. They've all done what you did, which was give up your job and do this for a living instead of working. And so you get this point where the lesson of life is, if it feels too good to be true, it's too good to be true, right? So if you're constantly winning, something's up. That's not going to last forever, and you mustn't get used to it. I'm not saying don't trade. I'm saying just be ready to notice that the paradigm has changed, and it's time for you to change with it. And that change might be actually stop trading. I'm going to go on holiday, or it might be, I was short, now I'm going to go long, or some variation. Now, in that situation where lots of little market makers have fled the field, leaving only big market makers who've got deep pockets and who now own the market, there is a danger, and I'm not saying that this happens, I'm accusing nobody, but we're all human. These guys now start getting much more perfect information about who's got what positions. And one could imagine a scenario where, let's say, the whole of retail is short gamma. They've all sold vol at 28 vol. They're all thinking, it's a bit risky, but screw it. I need to make a living, so I'm going to sell 50% of margin use on naked strangles just to make a living. And that all works out for a couple of weeks, and then suddenly market makers mark up the vols. Now, maybe they mark up the vols because they see something spooky, or maybe they mark up the vols because it's bonus time and the guy doesn't want to be showing a loss, and he's super long gamma, and so maybe he marks up vols by 10 or 20 vols for the week. Things look better from his point. I mean, who knows, right? One could imagine that years ago, all these options market makers drank in the same pubs or bars after work in the city, and you could imagine all kinds of conversations going on, and suddenly implied vols have gone up and everyone's on margin call. First thing they get liquidated, which causes a massive spike in vol, and it becomes self-prophesying. So there's a number of things that can sort of trigger a structural problem that has emerged in the market through behavior. And again, I reiterate, I'm accusing nobody. These things can be random, probably are random, but the structures are real, and they are the result of the continuous concerted human behavior of profit seeking, doing what we know to do. And the market is an engine which seeks out your weakness. It will allow you to succeed, and eventually, one by one, it will sniff out all the weaker players and it will kill them until there's only good players left. And if you're the last semi-good or bad player in the market, you're no longer going to be lucky, because the good players, it's like being the last guy left on a poker table where they're all pros and you're not. Right? So that's my little lecture.
One thing I will say that correlates, and I've got a few little comments. You can look at charts and you can say, okay, we've got this. We had a market move, went down, it held for days. A lot of people are jumping in. Vols are elevated. They think it's going down, so they're buying puts. Well, who's selling it? Right? It's market makers on the other side of that trade. When you see trading, and trading technically is level to level. That's why there's not a lot of trading in between levels, because there's activity. There's people with positions. There's market makers with positions, and they have to move it from these positions sometimes. Now, sometimes they get overwhelmed. It goes through them, but they will, as Richard said, they can hedge off with futures. There's things they can do to mitigate that, but eventually they're going to want to try and get that back. And people say, well, hang on, that's not fair. Well, hang on a second. These guys, you got to admit, these people are providing a service. They're providing liquidity, and they're taking a big risk to do so. So when we say things like, people say, well, manipulation and things, well, yes, but we're not using it in an accusatory sense. It's literally their job to make the markets, but they got to make money too. So sometimes we'll get these moves as we see a bit of a rebalancing for a whole host of reasons. It's not necessarily a zero-sum game. Now, Rich, I think you said there was a bunch of accounts wiped out when that last move.
Yeah, they reckon that there was in the move down to 26k, there was something like 150,000 accounts were liquidated. I don't know whether that means. I don't think it means the accounts went bankrupt. I think it means that positions in 150,000 accounts were liquidated, which is why we saw the exacerbated selling. And that was across multiple exchanges, not just Deribit.
Sure.
I was going to say about this structural thing, though, just adding what you were saying. If you look at the open interest around the 1st of September and Bitcoin on Deribit, actually, you can see that there's actually a big concentration of open interest at 27,500 and 28,000 and 27,000. So at each $500 level around expiry. Now, market makers are generally going to be long gamma around these areas, and so they're going to be bleeding theta, and they've got to make some money back. So what they do is they trade the gamma. As the market moves up, their calls get more expensive, and so they sell futures, and as the market moves down, their calls get cheaper, so they buy futures, and so that it ends up actually automatically buying low, selling high for them. So that's how you make money when you're long gamma, in a nutshell. The concerted action of all those guys doing that in size, in like 1,000 Bitcoins of size, will mean that they they are actually selling as the market rises and buying as the market falls, and so they're applying pressure, which will actually make the market sticky around one of those levels. So at the moment, we're kind of stuck at 27,500-ish, kind of, aren't we? Almost there. So it seems to have kind of got stuck around the 27,000 level, and it will probably stay there. It normally does, until one of the market makers goes, you know what? Because they're clever bastards, these guys. If we didn't hedge, we could risk, I don't know, losing $100,000 on theta. But if we didn't hedge, then we wouldn't drag the market back to 27,500. And these guys who are short the 27,000 put are all going to start panicking. And so we might find ourselves jumping a level down to 26,000 or 26,500. In which case we'll make loads of money because we're super long gamma, and screw those guys. So it's not guaranteed that it'll stay sticky. And like I say, these structures do appear. So you see a lot of people talking about open interest in the market. In crypto, it doesn't really matter. Hasn't really mattered up until now because options markets haven't been big enough for open interest to make a difference. But these days, now that the spot markets are thin, it's starting to make a difference, and it's worth keeping an eye on. They can't give you predictions about if it's going to break, but they will give you predictions about where it's going to go if it does break, because they will tend to break from level to level of open interest.
And that's why we love selling options, because if we're selling options around those levels, we've got a reasonable assurance of probability that we're going to be able to buy those back at a cheaper price, because they're going to get hung up at those levels or bounce off those levels. And that's basically my entire premise to trading. So there's a few takeaways here. You can watch the episode last week when we're making yourself kind of crash proof, right? These whether it's news driven, whether it's a rebalancing, the markets move. They're always going to move. That's the nature of the markets when you least expect it. So you have to expect the unexpected, but the things you can do to prepare. So watch last week's episode. We talk about that. We're always prepared for those moves. But I think that a few takeaways here. Never feel like you have to trade, and that's the lesson
Rule number one, right?
Yeah, you got into that where you thought, hey, screw this, I'm just going to trade for a living and it's going to pay me X amount. And well, it's not quite like that. Keep your day job.
And if you want my advice, I don't give trading advice, but I do give life advice to anyone who will listen. And that is, as you say, Shane, keep your day job. Do not trade. So make trading your only living. That's just stupid. That's like saying I'm going to play poker for a living. And you might be great at poker, right? And you might be fantastic at counting cards at blackjack. But there's going to be times when the casinos shut you out, and sometimes you're unlucky. So keep your day job, and don't be greedy. You can make a shit ton of money trading options. There's no need to be greedy. You've got plenty of time, and take a holiday 1 month a year. Go on a cruise. Go and walk with a backpack through, I don't know, Timbuktu or wherever it is. I don't even know where that is.
It's Africa.
Get out of the market, flatten the position, walk away, breathe, and live. Because the market will be there tomorrow, right? It's not you're not missing out by not being in it. Give it a month, there'll be more idiots to take to the cleaners.
Yeah. And be skeptical. Like I said, the markets are going to move. They're going to make crazy, weird moves. I mean, news comes out in the middle of the night. Yeah, these things happen. Just whatever. So you need to have a healthy skepticism, I think. Make sure you're only trading with probability on your side. If you're unsure, just trade smaller. And maybe more frequently. So that way you're smearing out. Let's say you're an options seller. Great. Okay, wonderful. Just do a little bit every day or twice a week or whatever that happens. And you'll end up having strikes and expiries smeared out over time. So your risk isn't all allocated on one strike and one expiry, causing you a big pain if the market happens to move against you to that
feeds into Alex's question, Alex Cottrell. Given that you've got dozens of positions spread across different strikes and dates, how do you manage which positions or which leg of which strategy? The short answer is, Alex, I couldn't care less. I don't even know. I don't even bother recording what strikes I sold. For me, I'm just selling vol, and I'll hedge it if I feel like I need to hedge it. I look at a risk ladder every day with my risk management tools and just see where my delta is, where my delta decay is, where my gamma is, what's risky, what's worth keeping, and I'll go through the book with a comb every day to decide if I can just prune out positions I don't need anymore. And this this mental model of, okay, so this is an iron condor, and I'm then taking off this leg, and so it's now half an iron condor, and I'm going to put my leg back on. These are kind of useful mental constructs for when you're kind of beginning, and they help you to learn the discipline. But in actual fact, I just see a book as an amorphous blob of risk, and couldn't really care less where that risk is, as long as it's not too concentrated, and I'm properly hedged.
Hey, we don't have too much more time here. We're over time, but let me ask you a question or two here, Richard. From Luke, when you say that you trade the relative vol or the smile, he's just saying relative to what? 10 delta versus 20, 10 versus ATM.
Yeah, well, so for instance, right now, the short-dated vols are like 38 vol, and the long-dated vols are 33 vol, whatever it is, and the long-dated are 45. So at the money. So arguably, buying short-dated options and selling long-dated options ought to, over time, pay you, all things being equal. And if you're gamma hedging, but also I like to trade the relative vol on the smile. So you'll see that the at the money vol is often a lot lower than the 10 delta vol. So that's up in the wings. And so often I take advantage of this I'm quite happy to sell low delta vol. Many options teachers will tell you not to, and I will teach you not to also, unless you are continuously prepared to hedge and get on it really fast if things move. And if things do move, what I'll find is if I've sold, let's say, I don't know, 10 delta calls at 45 vol, and the market does move up, and those calls are now at the money. Well, they're now at the money at 33 vol, for example. So they're now like 13 vols lower than they were. And on a relative value basis, if I've been delta hedging all the way up with enough granularity, I'll actually have made money. I'll have made more money on my hedges than I'll have lost on the increase in value of my calls. And now what I'll do is just buy those calls back at a loss, and then sell the futures that I've been using to capture that value, and then I'll resell those calls as maybe a strangle again out at 45 delta. So I'm now essentially buying 33 vol 45 vol. So I'm buying 33 vol and selling 45 vol. So again, I'm making a relative value trade. I'm buying low, selling high in terms of volatility rather than in terms of price. And once you start doing that, your book starts to get really mixed up and starts to look like my book, just positions everywhere.
Yeah, it's impossible to pick out.
But there's been method in that madness. What you're seeing is just the emergent effects of me doing relative value trading.
Dom asks if you were to gamify options trading. Isn't options just one big game, anyways? But what would be the rules of the game? What do we need to do to win consistently? Well, buy low, sell high, buy low.
You won't always. You will not always win. I've never met an option trader who can always win. Right.
Any trader.
Right. What you can do is you can play the odds. Actually, talking of gamifying it, I think options trading is a lot like card counting when you're playing blackjack. In blackjack, the depending on where you gamble, the dangers are that you might get barred or beaten up or killed. That was back in the 70s. These days, just barred, right? But the long and short of it is that the house picks up and goes home and refuses to play with you. And actually, the options market's the same. If you consistently win long enough and big enough, you will put the market makers out of business, and they'll say, "Well, screw this for a game of soldiers. We'll go and trade something else." So, in the end, even if you're the best trader in the world, you will still run out of people to play with because you'll kill them, and you won't be able to make any more money, and you will crush or bring the vols up to a level where you can no longer you're trading at fair value and therefore breaking even or less. The game is trade when it's in your favor and then go do something else when it's not.
Yeah,
simple as that.
Yeah, very good. Is the option wizard looking at the Deribit books? I assume it's just looking at the Deribit book.
Yes, it is.
Yeah. I could watch this later. Yes, I'll give you. Just give me a moment here, Shayoya, and I'll put a link in. Actually, I put a link in the chat for last week's talk about becoming crash proof. And of course, that's you can check that out. This week's episode, or today's episode, will be uploaded in the next hour or so after we're done. So we've got about time here for one more question. Let's see, Gendrea, notice that the D-vol, the daily vol, is less than historical. What about delta hedging in this situation?
That's a huge question. Yeah. What about it? Well, you've still got a delta hedge because you've got to manage your deltas. What you're saying is, essentially, how do I delta hedge in order to make that profitable for me? Well, you probably don't. If a D-vol is, I mean, these things are a guide, right? So if the D-vol is lower than the historical vol, then arguably, if that carries on and you sell vol, you're going to lose money. So you should be buying vol, arguably. That's assuming that the current situation is going to continue as like yesterday's situation. What do I see? I'm seeing D-vol currently 36 and historical vol of 40. Wow. Mm-hmm. Yeah, but that's coming from the recent move in prices, right? Mm-hmm. Yeah. Yeah, I mean, that kind of figures. I don't like selling vol if it's below 40, frankly.
Yeah. Johan jumped on too, and he said you can actually reach the option wizard without being logged in. I did not know that. And there's a link in the chat. You can always check that out, the options wizard on Deribit. All right, so that's a wrap for today. We've gone over time again, as we often do. But man, great questions. Always great questions. Thanks so much, everyone, for joining us.
And just a note to say, if you do join the Rogue Trader Academy, you do get access to our Telegram channel where you can ask us a question any time of the day or night. And in the gold package, you get one-on-one tuition from us.
Yeah, basically, Richard's laying there all night, just waiting for questions to come on his phone to wake him up to answer those questions.
That's exactly what I'm waiting for all night. Yeah.
Anyways, thanks so much, everyone, for joining us. Great to see you again, and we look forward to seeing you next week. Happy trading, and talk soon.
Okay.